To succeed and thrive at C-suite level, you need strategic clarity and operational excellence. Hello and welcome to the podcast. On today's podcast, I'm going to be joined by Brendan Gilmore. Brendan is a debt advisor, and this podcast is one of a pair that I am doing on the topic of fundraising. So you'll find another podcast about equity raising with Corinne Thompson in the show as well. So obviously, if you are in a startup or in a scale-up and you are looking to raise funds, these two podcasts are going to be particularly relevant and useful for you. However, even if you're not, and if you're an executive working in a large organization, I genuinely believe that every senior leader should have a good appreciation of how debt and equity markets work, how fundraising works. It's just part of being a senior leader and something to add to your arsenal. All of his recommendations are full of common sense. He draws distinctions between debt and equity, between what a lender is going to want to see versus what an investor is going to want to see. And everything is very implementable and common sense and useful. The podcast was recorded on the eve of the inauguration in the US in early 2025. So we will see how some of the observations and predictions pan out from there. But regardless of how they do, the tools and tricks and approach will definitely continue to be of relevance. If you are enjoying these podcasts, please do leave a review and subscribe so that you get the podcast automatically. They drop in now once every 2 weeks, and I really hope you're enjoying them. I'm certainly enjoying recording them. So that's it. Without further ado, let's go and speak to Brendan. I am delighted to be joined on the podcast today by Brendan Gilmore. Brendan is Managing Director of BPG Strategy. He has almost 30 years financial services experience working across lending, credit, workout, strategy and risk, and has a deep understanding of financial services from end to end. Since 2017, Brendan has acted as consultant and advisor to challenger banks, building societies, non-bank lenders, technology platforms, and startups. Brendan helps market participants to optimize strategy, proposition, operating models and risk, to acquire customers, to develop strategic partnerships, and of particular relevance to today's podcast, to secure debt funding for businesses. And that's what we're going to be talking about today. Brendan is also a regular speaker, panelist and moderator at FinTech, Banking and Building Society events. Brendan, welcome to the podcast.
That sounds like me. Thank you. Delighted to be here. How are you?
Very well, thank you. And listen, it's great to have you on board. We've known each other for a few years and you've always been amazing at explaining debt and debt markets to me and how they work and how, companies use and leverage debt and how they should and shouldn't use it. And I know we've got listeners who are founders of startups and who are in scale-ups. And then we probably have people in mainstream banks as well. But I maintain that every executive should understand some of these fundamentals of debt. So great to have you on today.
Oh, great. Oh, thank you for those kind words.
Before we get into all things debt, just tell us a bit about yourself, your background, and how you got into what you do.
So, as you said, I'm almost 30 years. And actually, every time I look at the biography, it has to kind of creep up and it gets a bit scary when you say close to 30 years in financial services. But 20 of those were as a banker, and I've managed to escape. But I had a slightly unusual career in that I worked in a number of different banks, a couple of jurisdictions, but crucially in most of the silos. So I got a really good understanding of how debt and lending works within the context of a financial institution. And that helped me to set me up for this now. So learned my trade and earned my stripes in corporate banking. Was then asked to come to London to set up a business for Bank of Ireland, a lending business. Did that. It was going quite well. But then, like everybody else in the late noughties, I became a workout banker. So having built a lending business, I got to learn how to dismantle one and everything that comes with that, which was a great insight in lending going wrong. And then after Bank of Ireland was downsizing, I moved to Metro Bank, where I ended up in risk. So became very conversant in the wider risk agenda, which again was very helpful. And then ended up on the exco of Bank of Cyprus UK, building out a business banking proposition. But toward the end of the crash and afterwards, I developed an interest in all things fintech and alternative lending. And you could see the world was shifting that way. So I developed a network and knowledge in that and was asked by a specialist lender to come and help with our proposition. So that set me up because I now have a network and knowledge of what went on in the old world lending. And now I have a network and knowledge of what goes on in the kind of the newer versions of that. So I just use the network and the knowledge on both sides to translate between, and I like to translate between old world and new world financial services. So that's the background. And it's ended up, as you said in the bio there, I can help on both sides with banks and with alternative lenders to bridge the gap.
Brilliant. And I know, there's lots of specialisms in debt, and I'm going to ask you to be a little bit of a generalist today. I think we said in the pre-discussion, I think of you as a specialist, and I'm going to ask you to be a bit of a GP today. But talk to us generally about clients being ready for debt. What's the profile of a company? What are the things that should be in place? When is a company ready to start thinking about taking on debt? And I suppose we should say, just before you answer that, we're not really talking here about sort of going to a high street bank and getting a bit of working capital finance. I think we're talking about more strategic finance here, but let me not put words in your mouth. Tell me how you think of it.
I think there's a lot of commonalities across everything. And even when you asked me to come on here, I was trying to think about it. And it was interesting thinking it through because there's just so many different aspects you need to consider across the whole piece, whether it's the type of debt or the source of debt or the just the approach to the process. And there's probably a university course in the full gamut of this. So we'll try and keep it high level, but hopefully it's useful for people. I think the first thing I'd say is you need to get a good debt advisor, and you'd expect me to say that, but hopefully by the end of this discussion, it'll become clear why. But as to readiness, I think there's two things. There are some core credentials that people have to have. The numbers have to be right in order to do that. But I think it's also a mindset. If you're looking for a strategic debt, as you call it, or if it's the first time a scale up has gone to engage with the debt markets, they have to think a little bit differently because they're probably used to operating with equity. And equity and debt are very different, as we all know, and it comes down to simple things like risk and return. But an equity investor wants, their 10x their money, 100x their money. A debt investor wants 1 point something x. And actually, they care more about the 1 point something than they do about the point something itself. They care about the one. They want to make sure they can get their money back. And founders or early stage or scale up businesses, first of all, they just want the money. So they'll say what they need to say, but they're used to engaging with an equity audience where, it's important to talk about shooting for the stars. And there's a bit of founder optimism, there's a bit of founder hubris that you need in order to kind of convince the equity markets to do what you want. Debt doesn't like that. Debt's not interested in your plans to globalize whatever it is or democratize whatever it is across the globe. They're looking for much more modest but achievable aims so that they can see that they'll get their money back. So I think, what they're looking for from the core credentials perspective is stable, predictable, identifiable cash flows. They'll be talking about things like EBITDA, which fundamentally, just does the business make money doing what it does before you consider the financing structure, before you consider the accounting tricks. So they look at that. They'll be looking at things like cash flow available for debt service. Is there, after all the costs are taken into account, enough to pay the interest? And in due course, is there enough to then start to amortize the debt and pay it down over time? So there's some fundamentals like that, but I think the mindset is really important. And people need
we
to
hope
be
you enjoyed the
ready
podcast.
For
more information about the How to Be a Books, the C-Suite Framework courses, the podcast, or to get in touch with me, head over to www.csuiteframework.com.
A debt investor needs to make sure everything works, so they have to scrutinize this to a real degree. So they're going to expect, and you're going to have proper procedures in place, proper processes, proper accounting, proper controls. You're going to have to have good financial forecasts based on rational assumptions that people can test and sort of, put a base case on, put a downside case on. So things that, they will exist in the equity deck, but they'll be a little bit more speculative in the equity deck. With debt, it's going to be a lot more closely scrutinized. And I guess it depends on what the purpose of the money is as well. And sorry, actually, even before I go on to that, I think that level of scrutiny sometimes founders will push back on because they think, just trust me to do this. But actually, I always see it as something you can listen carefully to. So if a banker or a debt provider is coming to you and asking you all these questions, try to learn something from it because there's usually a really good reason why they're asking them. You might think, that'll never happen. The reason they're asking them is because it probably has. And therefore, if they're asking you to point out a weakness, or to justify why you're doing something in a particular way, I do my best to answer the question, but also to understand why they're asking it and ask it back. It's almost, and I maybe I'm stretching here, but it's almost like free consultancy for your business because they will identify weaknesses in your business model that you might not have thought of. So I would say embrace it, even though it might be a little bit frustrating at the time.
And just before you move off that point, I was going to make the point about consulting. And it's interesting, this podcast is kind of a twin of another one that we're doing covering equity fundraising. And in the equity one, Karine says in her training that, if one person asks you for something that's not already in your financial model, you can evaluate it on its merits. If two potential investors ask you the question, you know what? It's a good question and there's some merit to it. And also the fact, she said that your financial model and your deck and your pitch and everything, yes, it's all about TAM, SAM, SOM, the size of the market, the scale, the potential, the excitement of, this new model. Whereas what's really coming across is you really have to tailor your deck and your pitch and everything to the audience in quite a substantial way.
Yeah, absolutely. Absolutely. It's important because, the equity investor wants to see this thing succeed massively, and that's what they're buying into. Whereas a debt investor just wants it not to fail, and therefore they're looking at these things. And that's why, as I say, you can learn an awful lot by the questions they're asking and the structures they're putting around it. But they are, you do have to be ready for those controls and for the covenants, and you have to be ready not to lose your business, but to understand that that's what the debt investor is putting in. They're trying to make sure they get their money back and that they get a reasonable return on it. But if you're not performing the way you said you would, then they're going to step in because that's what they've done. They've put it on that basis that they can step in, and the controls will allow them to, trigger changes in how you behave or what you do or how you do it. It also depends, your readiness. It depends on the purpose. But the main purpose of debt should be to maintain and grow those cash flows that you've already built up, that are predictable, that are stable, that are identifiable. So a debt investor is always going to look at you doing more of the same product in the same market. The moment you start saying, well, I want this debt because I want to go into a new market we know nothing about, that's when the red flags are sort of raised. Or we want to do something completely alien to what we've been doing before. You can do that on a controlled basis if the leverage is low enough, but just what debt wants to do is slow and steady wins the race. That's always the way they're going to look at it. So that's what you've got to think about when you're getting ready to engage with the debt markets.
Whereas one very legitimate use of equity seems to be expansion into a new market. If you're having success in one, speculatively going into another.
Yeah, and look, it's a bit loose, as all these things are, in generalizing, but one is based on assumptions and based on speculation. The other one is based on, facts and reality, what's happening today.
And just to draw the circle on readiness for debt. So you've talked about mindset, you've talked about being ready for scrutiny, you've talked about being established, you talked about EBITDA. So we are talking about profitable, net cash positive businesses always.
As with all of these things, I always think there's money available for everything, particularly in this city. It just depends on how much you're going to pay, how quickly you want it, and how many of your children you're willing to hand over as security. So if you can secure something a different way, then there might be an option to, a simple example, if you can secure it against your house, then they don't really care what you go and do with the money because they can, come and take your house. But in reality, the business should be profitable. It should be generating free cash flows to be able to pay the interest and to pay the principal down over time. So yes, if you're not profitable, it's going to be a lot harder to generate cash flow based debt.
And beyond that, then, when someone approaches you for help in terms of raising debt, are there any other factors that you assess or things that you're looking for when deciding whether to take on that client?
From debt raising, I tend to work on a success only basis, and therefore I do have to, be clear in my own mind that they are ready for it, that they have the right credentials and that they have the right mindset. But I also, on the other side, I need to know that I have someone, and ideally more than one, that I can go to. And we'll probably touch on that later in terms of the sources of debt, because they are many and varied. But I like to know that there's somebody I can go to. So it may be that I think the business model is fantastic, but actually nobody in the debt markets will look at it. And I've got one of those at the moment, actually, in a particularly niche space where I think that the business model is fantastic. But debt markets tend to be quite conventional in how they assess things. And that's part of the skill of a debt advisor, is to be able to translate something that might be new and different into the mindset of that old conventional, kind of putting into particular pigeonholes. So it's those two. Is the business ready? And is there a market available for this debt? And I have to be sort of honest with some people sometimes and say, I just don't think it'll work. And therefore, you're not ready, or actually you might be ready, but the market's not ready for you. So it's one of those two things normally.
And just as a follow-up, is there anything in terms of the individuals who approach you? Are there characteristics that you're looking for in the person?
Yeah, I mean, again, it's a realism about that difference between equity and debt. It's a realism of understanding that debt is different. So yeah, and you don't always get that in those individuals. That's for sure. It'd be wrong to kind of categorize people into particular types. There are some backgrounds that suit themselves to this and some that definitely don't.
So let's dig in a little bit to the different types of debt that we're talking about here. How should scale-up organizations think about them? And, if you want to also touch on blends of debt and equity as well, talk us through all that.
Yeah, so look, again, probably the easiest answer is it depends, because there's so many different types of debt that you can look at, across the piece. And I don't think people tend to stop and think this. People just want the money and therefore go with whoever gives it to them first. And I think there's an awful lot of people who don't go for debt and should, and there's other people who have the wrong type of debt, but that's just because the market is so varied. But if you break it down into its simplest, you've got term debt, okay? And that should be for things like equipment and premises, things that, something that will deliver value to the business over the term of that debt. So you can borrow, on that basis. There's revolvers where it's for working capital cycle. So that might be something like buying stock ahead of a seasonal need. You need the cash to pay for that stock now. It'll come in when you sell it after Christmas or whenever it is. The type of debt will vary, whether it can be secured or unsecured. Going back to my house example earlier, if you've got a house or a property you can secure it against, then the debt is easier to get. That might influence your decision. Or it might be unsecured, in which case there's fewer providers of it out there. It might be better for you because you're not putting something of your own security up, and that might be more attractive, but there is fewer sources of that. And then it's about the nature of the business. So a lot of lenders will look at a business and say, I don't really care about the underlying business. I just care about the security they can give me. And asset finance or invoice finance are good examples of that. So if you happen to be a delivery company, there are lots of funders out there who'll fund your van fleet because they can fund an advance rate against your van or a loan to value at 60%, and they know that if something goes wrong, they can take the van. So they care about your van more than they care about your ability to deliver or to run the business properly. Similarly with invoice finance, if your customers are strong, credit-worthy businesses, there are lenders out there who'll give you funding against that. So if you're selling to a large multinational, they might be quite happy to advance against that particular invoice rather than care about your underlying cash flow generation or the ability to do that.
And that is quite a mindset change for a founder who is incredibly proud of the business that they've created and who is used to pitching their business all day, every day, to have a lender go, I don't really care about that, but your vans look okay.
Yeah. Now, the lender doesn't say it in so many terms, but actually they go, look, I'll give you 60% against the van, or I'll give you 80% against Tesco invoice, because we're quite happy that they will pay if you can show us a valid invoice. But at that stage, the driver for the founder is to get cheaper cash flow into the business. And their choice is, do I get equity, which means I'm diluted, or do I raise against this invoice or raise against this asset, which means that I get cheaper funding and I don't have to dilute. So that's the trade-off. So sometimes you need to swallow your pride as a founder and say, well, actually, my customers are financially stronger than mine or my assets are. And then there's other versions like inventory finance, if you want to just finance stock, but that will only apply to particular types of, in most cases, finished stock that they can sell somewhere else if something goes wrong. There are newer forms of this, like revenue-based finance, which are focused on subscription-based businesses, and particularly in the software as a service or SaaS stage, where if you can demonstrate long-term subscription-based contracts, then you can borrow against those future cash flows and invest that in marketing or invest it in product development. And that's a sort of a slight hybrid. And then there's asset-based lending, which is a bit of a hybrid of all of these. So a bit of a property and a little bit of stock and a little bit of invoice and a little bit of cash flow, and they blend it all together. But at the racier end, you've got venture debt, which is probably somewhere between debt and equity, but it really depends on the profile of the company. And it tends and is sort of evolved into a situation where people use it for VC-backed businesses where they just want to hit another milestone to be able to raise at the next highest valuation. And going out to equity is too expensive. But if they can borrow $500,000, $1 million from some of the venture debt providers that gets them to that next milestone, then they can go out and raise at a higher level. It's trickier to get venture debt, and it's a little bit more complex and a little bit more it's a broader area, and probably could do a podcast on its own.
And then presumably some of those might also be convertible into equity if certain criteria are or not met.
Yeah, and venture debt providers are quite happy to do that because they want to participate in the upside. So it might be that they're not draining cash from the business in the way of either interest payments or in amortization, they're happy to kind of flip it at some point in the future. Yeah, so there is all of those different things, but it's a very broad area and lots of different things. There's lots of different choices and trade-offs to be made.
Excellent. Okay, so all the different types of debt, and obviously then what you do is counsel your clients on their particular situation and look at the combinations of those things that could be there. So having done that, we then go on to talk about sources of debt. Let's just do that straight after this message. This podcast is brought to you by the best-selling How to Be a range of books. These books, authored by me, Jennifer Geary, in collaboration with other seasoned experts, break down roles such as the COO, Chief Risk Officer, Chief People Officer, and Chief Sustainability Officer into their component parts. They explain the technical capabilities you need, but also how to operate at this level, preparing yourself, getting to know your peers, engaging with culture, strategy, building your team, and much more. Over 30,000 books have been sold, and the books have received overwhelmingly positive reviews. There's even a book about the role of AI called The Augmented COO. Check out the books, available on Amazon and Waterstones now. Okay, Brendan, so we're back and we've talked about readiness for debt. We've talked about some of the very high-level types of debt that are there, and obviously this gets really complex. Having identified an ideal blend or construct or type of debt that a particular organisation wants to go after, talk to us about how you help them find those sources of debt.
So the simplest thing is having the network in the sources of debt, but actually that's quite broad. And it will depend on some of the things we've talked about, what they're ready for, what's appropriate for them. But there's many and varied sources of debt, and particularly in this market because it's quite mature. Most lenders will look for one or a combination of three ways out when they put debt in. So it's either the cash flow that the business is generating to pay them back. It'll be the security they have in order to take that if there's any issue with the debt going wrong, or some sort of third-party support. And the reason I say that is depending on the mix of that will depend on the source of debt. So typically here you'll have regulated banks, you'll have non-bank lenders, and you'll have fintechs. And there's more sort of, niche versions of each of those. But if you think about the high street banks, you can go to high street banks if you're looking for a term loan, and they've got commercial and corporate units. If you've got a term loan and you've got a property you want to secure it against. So if somebody happens to own the building they're operating in, they tend to like those sorts of debt because there's a business they can understand the cash flow and there's a property they can secure against. So they would be appropriate for that type of fairly basic, fairly cheap debt. And then you look at the kind of the older established banks in this market who also have a little bit more, a broader risk appetite, let's say, but there's many of those. So you've got the big five high street, but then if you think of some of the banks like a Bank of Ireland or a Handelsbanken or Bank Leumi or Close Brothers, there's Hampshire Trust, Secure Trust, Castle Trust, Arbuthnot, Latham Co. You could go on for ages. All of these have got little niche specialisms, but they've got a slightly broader risk appetite than some of the high street banks will have. So they're worth considering as a potential source of debt. And then you have the new slew of challengers and the kind of the ones that trip off the tongue are Metro Bank or Shawbrook Bank, Oak, North Aldermore. They would probably step again in terms of risk appetite or speed of decision making. They'll charge a little bit more, but they'll have a broader risk appetite and might be willing to look at something that is slightly off-piste, which makes things a little bit more accessible for a scale-up business. But then there's a whole load of challenger banks you've never heard of, probably, or most people have never heard of, whether it's GB Bank or Oxbury or Redwood Bank or DF Capital, all of whom have particular niches or particular desire to do specific sectors or subsectors. And that's just the banks. That's just the regulated banks. And the beauty of a regulated bank is that they ought to be cheaper because they're deposit funded. That helps. But by being deposit funded, they tend to have a more limited risk appetite and longer processes. We have a huge group of non-bank lenders in the UK, and there's definitely too many to mention. But if you think of people like Bibby and SME Capital, E-Capital, Navuna, Thin Cats, White Oak, all of these are not deposit funded, so they won't be the cheapest, but they'll definitely have a broader risk appetite and they'll move very quickly to get deals done. So they'll look at things the banks won't look at. And sometimes that's more important to the founder. Speed is important to the founder as much as, getting the cheapest deal, because it might be that they're on the cusp of a new contract or investing in a new product or about to hit a new market. So you've got to consider those factors as well. And then fintech lenders, I mean, Funding Circle and iWalker and Wayflyer and people, all of these have come up that serve particular niches, and they serve things in a way that are quicker and easier for others for people to engage with. So it tends to be a combination of speed, simplicity, and price. And it depends on what's important to you as to what you go for. But the sources are many and varied, as I say. So it really does depend on the type of debt and your readiness for it.
And I know some of this from the other side, Brendan, in terms of, so I've worked in one of those business banks. I've worked in a software company that serves some of those business banks. And it feels like particularly the last kind of 5 to 8 years, let's say 8 years or so, it got very competitive from being like there was a dearth of funding, particularly for small and medium enterprises, and then everybody piled in. And it does compete very keenly, I think, on speed, on execution, on customer experience, on being able to capture the information needed, expeditiously and give the customer the answer that they need. So given all of that, it should be a pretty good experience for a good company, certainly better than it was.
Yeah, no, absolutely. I mean, I think it's now a fact in the UK that there is more lending done to SMEs by non-bank and challenger bank lenders than there is by the high street. So the mood has shifted completely, or the appetite has shifted completely. And look, the newer businesses are set up to give the SMEs what they need. I think when we were talking a couple of weeks ago, I mentioned that SMEs spend about an hour a year on their funding needs, and they tend to approach their funder 3 weeks after they need the money. That was borne out by research that I had at Virgin Money when I was putting an SME proposition in place there. And it's about speed, it's about simplicity, it's about the fact that SMEs particularly, or founder-led businesses, they're very busy on everything else. Funding is a critical input, but it's only one input. It's only one share of their mindset or the bandwidth. And they need to just try to get the money in to make it work. So if you can give it to them quickly, if you can give it to them with the, simplest of processes, because actually the funder plugs into your systems and extracts the data, or plugs into third-party systems and extracts the data, and comes back to you with an answer in 24 hours. That's perfect. And the banks are just not able to do that yet. They've tried and they're getting better, but they're just not there yet.
There's lots to unpick in there. I feel like I just need to repeat those two stats that you said. So the average business SME spends 1 hour a year thinking about funding. I'm guessing that's probably not enough. And usually after they need it. So explain that 3 weeks after they need it. How are you defining that?
Well, it's just they tend to, because they're busy with other things and they don't get around to it, and they go, right, I need to do something about this. And it tends to be 3 weeks after that they go. And that can be for a good reason or a bad reason. It doesn't necessarily have to mean they're running out of money. It can be, to fund a contract. And clearly, look, these are generalizations and averages. But the point being that particularly in the SME market, those funders that can deliver them a quick answer and with the minimum of friction, they're the ones that are winning. And actually it was interesting, even with iWalker, in the beginning, people almost dismissed them as, oh, well, they're only lending to people that we don't want to lend to. But actually iWalker found, and I think Funding Circle and others found, that because of the speed and how slick and easy their processes were, that some better creditworthy clients who could get cheaper funding elsewhere were going to them, because it actually just press the button, they get the funding, and they can move on and focus on what they want to do with the money rather than the getting of the money. Now, as a business scales up, they should be getting a finance director or a treasurer in place who can scour the market, who can optimize the funding. But in the scale of business, they're busy. So it tends to be those that have a slick, quick answer, who understand their business, who are prepared to understand their business, who are not just saying, show me the security and I'll lend you the money.
So there's money there for convenience. There's a big convenience premium.
Absolutely.
And just to close out on sources of debt, we obviously, we talked about how there was this upsurge of lending for SMEs. Obviously, since sort of 2022, the market has been somewhat different, and we're now in early 2025. How would you characterize the market right now?
Right now, on the 17th of January, I would say one thing. After Monday and Trump's inauguration, I might say something very different. And it sounds very grand talking geopolitically about this, but I do think it will have an impact on the market. At the moment, in the start of January, there seems to be a lot of activity. There seems to be that fresh January start. Everybody has new targets to hit. There are people willing to look at debt deals for sure. a little bit apprehensive as to what happens on Monday and what happens with tariffs and what happens to economic outlook and therefore what that will do for 2025, because that's going to have an impact on interest rates, and interest rates are going to determine whether people are risk on or risk off. So, and I think you'll see that more acutely in the big banks rather than maybe in some of the specialist lenders who've banked their funds and will still go out there. But the market is okay at the moment. I think, there are good businesses will get funding. There's no doubt about that. It's a question of optimizing that funding. But I think you've hit the nail on the head that there's more activity outside the banks than there is inside the banks in this space particularly.
Well, this podcast will go out post the 20th of Jan, so I might need you to come back and provide an addendum if something happens. So we'll just have to see. But I do agree. I've never been at the beginning of a year and been so not quite sure as to where things are going to pan out from here. It does feel wide open this year. It's going to be very interesting.
If we forget Monday, which you can't really, but it definitely seemed to be a bit risk off the year before last and a little bit throughout last year, and people, particularly in lenders or in investors, they weren't being fired for saying no. I think it seems to be unfreezing a little bit that people are probably having to find a way to say yes, or they might get fired this year. So that, people are going to have to deploy. There is plenty of capital to deploy out there, but we'll see what happens on Monday, and then people might kind of change their tune. I don't know.
Yeah, and it always, uncertainty is just the worst thing in the markets, isn't it? It's just the not knowing is the worst. You can deal with good and bad. Not knowing is really tough. Okay, so we've talked about types of debt. We've talked about sources of debt. So let's imagine we've got a structure. We broadly know where we want to go to. Talk us through the debt raising process and the major steps in that.
So, as you say, we've gone through a process. I'll have had an initial, intro exploratory call with the borrower. My key there is to try and understand the business model and the credit risk so that I can translate that into, how I then communicate that with the funders. So we'll go through that sort of readiness, the type of debt, but also their expectations. Do they have a particular type of debt? Do they have a particular pricing in mind? Do they have particular expectations of how much security they'll give? Once we tease all of that out, I help them to create a very short teaser. And this is really important because what we really want to do here is make the lender's life easier so that when they get the deal, we get their engagement and we get their attention. And there is that old adage of, sorry, I wrote you a long letter, I didn't have time to write a short one. This is the time where you write the short letter. You put the time in so that there's something in front of the lender that they can get what they need to quickly and go, yes, this is a deal for us. Or actually often valuably, no, this isn't a deal for us. Because what you don't want is a back and forth over 3-4 weeks where they're asking for more information and then they say no. What they need as much as possible up front. And that includes the kind of the things you'd expect. The legal entity, because they want to know if there's any conflicts. The headline ask about what it is that they want. The background on the business, the model, the track record, the strategy, where they're going with this. Why there's a particular market opportunity that, this is going to continue to grow and they're going to get to use the debt. Financials. The operating infrastructure of the business, the team, absolutely critical. People with experience who know the sector, things like that you can demonstrate it. A bit about the debt required, a bit about the other funding the business has, get a little bit about the equity and the equity plans, because it might be that this just gets them to the next level. If this is a scale up, have they got plans to raise another chunk of equity to go further? Where is that going to come from? Because the debt investor is going to want to buy into the long-term sustainability of this business. And then we tease them with what else is available, if they sign an NDA. So we need to give them enough information without an NDA to say, I'd like to look into this business more deeply. But then you're getting into cap tables and CVs and policies and procedures and, fully detailed forecasts and accounts and anything in terms of business plan and strategy. But that's the focus in the beginning of the process, is to get that teaser right. And I want that to be, no more than 2 or 3 pages so that people can flick through it very quickly in work, on the phone, wherever it is, just so they can say, actually, I want to have delve deeper into this deal. And I will then assess that against the network that I have. And typically I'd like to approach a few to get a flavor. So definitely if it's suitable for a high street bank, I'll go to a high street bank. But I'll also probably go to a challenger bank and a non-bank with the permission and the approval of the borrower, of course. But I'll go to a variety, because you want to get a variety of answers back. You want to say, well, you can have money at 3% if you're prepared to wait 6 months for a bank process. You can have money at 7% if you're prepared to give a bit of a personal guarantee in your house, because that's what the challenger bank wants. Or you can pay 10% to a non-bank lender who'll give it to you tomorrow, under other circumstances. So ideally, you go through that. So I'll go through my list and say, here are the 5 or 10 or whatever it is, funders that I think would be appropriate. Allow the borrower to choose, because they might have a relationship with one, or they might not like one, or whatever it is, they can decide who we go to. And then we go out. And once the teaser has gone out, give them a few days to have a look through it and then chase it up. And if people bite and they're interested, then it's an intro call with the borrower, see if there's an alignment there. And there has to be a fit on both sides. They have to get each other and be happy to work with each other. And if that goes well, you're into putting an NDA in place, you're maybe setting up a data room or sharing kind of the extra detail that I talked about earlier. And then from there on, it's just really managing the back and forth about how do they get what they need to go to credit committee, to get term sheet issued. Ideally, what I want to get is indicative terms as soon as possible, so non-binding indicative terms, just so we have a flavour of the deal. And then the process can be as long and short as it takes, really. And I tend to hold their hand through the process until the money's in the bank. But, it's important that we get a good idea from each funder of what the rate's going to be, what the fees are going to be, what sort of amount they're prepared to do, at what loan to value, how quickly they can do it, what sort of covenants they want, what sort of security they want. No two processes are the same, I think is probably fair to say.
And then, assuming all that gets done and the credit committee signs it off and your favoured bank or lender comes back and says, okay, you've got it. A big takeaway in doing the same podcast with Karine on the equity side was you're celebrating when you've got the terms signed and agreed. And then there's a massive amount of due diligence. You've kind of come over the line and then it's like all the due diligence starts, right?
So it does depend on the nature of the funding and the nature of the debt, because if it's a secured loan against a property and the property value has come back at $1 million and you're borrowing $500,000 against it, then it's relatively straightforward. And the legal docs will take a while. With equity, the due diligence is probably not more detailed, but it happens in a different sequence. Some of the due diligence required for debt will be done before they go to the credit committee and get the sign off. But actually different funders, we talked earlier, the niche that I focus most on at the moment is finding funding for lenders. So lenders who then provide it, the non-bank lenders particularly. And the funders who operate in that space have very different approaches. Some will give indicative terms at the end of the first call. Others will wait until they've gone through credit committee in order to give their indicative terms. And the sequence of the due diligence is very different. Some will use external third parties for due diligence. Others will do it themselves. And this is why, as I said at the outset, get a decent debt advisor, because you need to understand the different approaches and to be able to navigate them. So it does depend, but yes, the way I always think about it is you've won a ticket to run the marathon when you get your credit approved term sheet. You've now got to run the marathon. That's the issue. And it's the same with equity.
Yeah, a huge amount of energy still needed when you think you might be finished. And as you were talking, it's mind-boggling to me that in this fintech day and age with all the digital tools that we have, with some of the mainstream banks, you're still talking about a process in terms of multiple months, 3, 4, 5, 6 months. And I can't help but boast a little about a bank I worked with in a previous role where they had, I think it was 8 to 10 weeks of loan processing, which we shortened to 2 to 3 days, due to having better systems, due to capturing the information once in the right place, only asking for it once, capturing it once, automating things like generation of memos and all that sort of thing. It's amazing to me that, some banks are still taking months over this.
It's unfair to tar them all with the same brush, and some have got better for sure. But you know how difficult it is to, affect change in banks and how to marry up all of the legacy systems and change risk appetites and have people think differently. And that's what's still holding them back, to be honest. And, there's lots of other distractions. The SME market is important, but it's not the most important in a lot of the big banks' minds. They'll all talk a good game, but actually, they make a lot of money on the personal side, and it's easy because it's homogenous. They make a lot of money on the corporate side because, they've got, lots of staff looking after the corporate relationships. SME always sort of is stuck in the middle, and it swings from over automating it to and losing the personal touch to putting too many relationship managers on it, and then it becomes too expensive. And I think that blend is getting better. The technology has caught up now, and AI will take it to a new level in terms of personalizing it and making people get the advice they need when they need it. But it's difficult to get SME right in a big bank because they've got other things going on. It's easier for a small specialist lender to get it right because it's the only thing they're focused on, and they've built the tech with this in mind. They're not trying to squeeze their lending end-to-end customer journey into a process that already exists in a bank. And that's where they've been able to kind of grow market share.
And I was just about to make the point that you made on AI as well, the potential for it to be a force for personalization or depersonalization, depending on whether you do it well or badly. And I think that's the challenge ahead, isn't it?
Yeah, it is for sure.
Brendan, this is all fascinating, and you've laid it out really clearly, which has been really helpful. We're getting close to wrapping up, but I did want to ask you, first of all, if there's anything else that you wish people knew about the process, but I also wanted to know, what one thing do you say to your clients more than anything else?
I think in the context of first-time debt borrower, which is kind of where we started, somebody in a scale-up who's moving away from equity and into debt, I always say in the early stages you have to pay a premium to buy a track record to take to the next funder where the funding cost will come down. So you probably won't like the first debt term sheet you get, and you probably won't like the fact that it comes with too many controls and too much security and not enough wriggle room. But that's the price you have to pay in order to reduce the funding cost over the long term, which is where the value is created. So if you start paying 8-9% now, the thinking should be, how do we get this to 2 or 3% in the future? And that delta will create the value in the equity. So it's that line I do find myself repeating. You have to pay a premium to buy a track record. And the track record is what cheaper funders want to see. That's all that matters to them.
As with so many things with a startup and scaling organization, 0 to 1 is always the hardest.
Absolutely.
Brendan, it has been an absolute pleasure talking to you today and really illuminating. And thank you for laying that all out. As you say, 2025 is going to be a really interesting time. Let's hope for growth. Let's hope for prosperity. Let's hope for lots of good things happening. And depending, as you say, on what happens in the next while, we might have you back for a little catch up at some point. But Brendan of BPG Capital, thank you very much for coming today.
Delighted. Thank you. Take care.
We hope you enjoyed the podcast. For more information about the How to Be a books, the C-Suite Framework courses, the podcast, or to get in touch with me, head over to www.csuiteframework.com.